Hello there, and welcome. In this guide, put together with the incredible tax experts at My Tax Accountant, we are going to tackle a topic that can cause a whole lot of confusion and some pretty nasty surprises. It's called non-coded income. Now, I know it sounds like pure tax jargon, but trust me, getting your head around it is absolutely crucial for staying on the right side of HMRC. So, let's dive in.
You know that feeling, right? That brown envelope from HMRC lands on your doormat? You open it, your eyes scan down to the bottom line and, whoa, the amount you owe is just way bigger than you ever expected. It's that horrible sinking feeling in your stomach that can completely mess up your budget and leave you thinking, how on earth did that happen?
Well, there's a very, very good chance the culprit is something called non-coded income. Over the next few minutes, we're going to break it all down. We'll decode that jargon, we'll look at where this kind of income actually comes from, understand the real impact it has on your wallet, and, most importantly, show you exactly how to stay firmly in control.
Okay, so let's start with that mystery tax bill, the one that causes so much stress. You know, it almost always comes down to income that HMRC doesn't know about automatically. The clue is right there in the name. It's income that has not been coded into your tax code.
So to really get what this means, we first need a super quick refresher on how tax normally works for most people. The system is designed to be pretty simple. It's called PAYE, or pay as you earn. And for the most part, it works great, but it has a blind spot. It can't see everything.
You see, if you're an employee, you're used to the PAYE system. Your employer uses your tax code to deduct tax and national insurance before your salary even hits your bank account. It's all done for you. Well, non-coded income is simply any taxable money that falls outside of that automated system. Because HMRC doesn't get a payslip for it, no tax gets taken off for you automatically.
And this really shows the key difference, doesn't it? With payee income like your salary, it's all handled for you. But with non-coded income, the responsibility totally flips over to you. It's money that you've received in full with no tax paid, and the duty is on you and you alone to tell HMRC about it. Think of it like a prepaid meal plan versus ordering from the menu. With the second one, you have to settle the bill yourself at the end.
So, what kind of money are we actually talking about here? I mean, this isn't some rare, obscure thing. In fact, with the rise of the gig economy, side hustles, and all the different ways people are earning a living now, it's becoming incredibly common. Let's look at a few real-world examples you might recognize.
First up, the classic side hustle. Let's take Jane, a consultant based in London. Her main job is taxed through PAYE, nice and simple. But on the weekends, she does some freelance work. Now, when a client pays her 500 quid, that money lands directly in her bank account with zero tax deducted. It's so easy to just see that as extra cash and totally forget that HMRC will want its cut later on.
And another huge one is rental income. Imagine David. He owns a buy-to-let flat and gets a steady £12,000 a year from his tenants. That rent goes straight into his account. HMRC has no way of taking tax from that at source. Now, of course, David can deduct his allowable expenses, things like maintenance or letting agent fees, but at the end of the day, the responsibility to report the profit is 100% his. And then, of course, you've got money from savings and investments. And this one can be a little bit sneaky. You see, we all get tax-free allowances for things like the interest from our savings or dividends from shares, which is fantastic. But if you're lucky enough to earn more than those allowances, that extra bit on top becomes taxable non-coded income that you need to declare yourself.
Okay, time for a quick pro tip. This is a good one. The government gives you something called the trading allowance. This is brilliant. It lets you earn up to £1,000 a year from a side hustle or other little bits of casual work completely tax-free. And the best part? If you're under that limit, you don't even have to tell HMRC about it. It's absolutely perfect for anyone just starting out.
But, and this is so important, be really careful. The second you earn just £1 over that allowance, say £1,001, the rule completely flips. You then have to declare the entire amount to HMRC, not just that extra pound over the top. It's an all-or-nothing allowance, and honestly, misunderstanding this is such a common trap. Now stay with me, because the next point might just surprise you. Right, so we know what it is and where it comes from. But why does it matter so much? This next part is really the heart of the issue, and it explains exactly why those surprise tax bills happen. This is how that lovely extra income can come back to bite you.
Okay, take a good look at these income tax bands for the 2025-26 tax year. Here is the single most important thing you need to understand. Your non-coded income does not get taxed in a separate little pot. It gets stacked right on top of your main salary. Think of it as the final slice of your earnings, which means it gets taxed at your highest possible rate. This is the crucial detail that catches so many people out.
Let's make this crystal clear with an example. So meet Liam. His day job pays him £48,000 a year. He's sitting there comfortably in the 20% basic rate tax band. On the side, he made a tidy £5,000 from some freelance design work. Brilliant. But hang on. When you add that freelance income to his salary, his total income for the year becomes £53,000. And as you can see from this chart, that extra chunk of cash pushes him over the higher rate threshold of £50,270. So what does that actually mean for the tax he has to pay?
Well, the result is that the top slice of his freelance money, the bit above that threshold, is suddenly being taxed at 40%, not the 20% he might have assumed. The tax rate on that extra cash has literally doubled, creating a surprise bill of over £1,000. That is a huge shock if you're not prepared for it. And that's not all. Here's where most people go wrong.
Clearly, you can't just cross your fingers and hope for the best. You've got to be proactive. So let's look at the next step, the practical stuff. How to report this income and the deadlines you absolutely cannot afford to miss. Being organized is your best defense against a nasty tax shock.
Luckily, the process isn't as scary as it sounds when you break it down. First, if you've earned over that £1,000 trading allowance, you have to register for self-assessment with HMRC. Step 2, and you have to be disciplined here, is to keep good records of your income and any relevant expenses. This doesn't have to be complicated. A simple spreadsheet is a great place to start. Finally, you pull all that information together, file your tax return online, and then pay the bill.
Now, these dates are non-negotiable. Seriously, put them in your calendar right now. You must register for self-assessment by the 5th of October, after the tax year ends. And then there's the big one, the 31st of January. That is the final deadline to both file your online return and pay what you owe. Miss it by a single day and you get an instant £100 penalty. And listen to this, that penalty applies even if you don't owe any tax. It's a fine for being late, pure and simple.
Look, I get it. This can all feel like a bit much, especially if you're juggling a full-time job, a side hustle, and, everything else life throws at you. But the great news is you absolutely do not have to figure this all out on your own.
At the end of the day, tax can be complicated, and getting it wrong can be really stressful and expensive. But trying to muddle through it by yourself just isn't your only option. Getting your tax right is so important, and getting professional help can give you complete peace of mind.
Now, just a quick and important note here. The information we've gone over today is for general guidance only. It absolutely shouldn't be the only thing you rely on when making financial decisions, because everyone's tax situation is unique. So before you take any action, you must consult an expert.
And for that kind of expert personalized advice, we highly recommend getting in touch with the team at My Tax Accountant. They are the experts who help put this guide together, and they can help you navigate your specific situation. You can call them on 020-857-8531, or you can email them at info@mytaxaccountant.co.uk. For a more detailed read, do check out the full article on their blog. And for more clear, simple tax tips just like this, be sure to subscribe to their YouTube channel. We really hope this has helped clear things up. Thanks so much for watching.